Yo, what is up guys? I'm back with another video. Today I'm going to be revealing the strategy that got me payouts at 15 years old. Alright, so I trade the continuation strategy, but there are some tweaks in it that most people do not recognize that can actually help them with their continuation strategy. These tweaks came over time, they came over experience, and before when I was trading the same strategy, I was trading like a very simple and a very basic continuation strategy, but now I've evolved it over time. So I'm going to be sharing it with you guys. All right. So first, start off with what do I use, right? Because everyone needs confluences in their strategy. OTE and high time frame fair value gaps. These are my must-haves. All right. If either of these two are not in a trade, then I'm not going to be entering the trade. All right. So here, 0.62, 0.75, 0.79, those are the levels that I use in my OTE. And then my fair value gaps, I go from the 5 minute all the way to the daily time frame. So sometimes I use 5 minute gaps, sometimes I use 15, sometimes 1 hour, 4 hour daily, you get the point, right? So those are my must haves. SMT, right? These are extra ones. SMT, lower resistance liquidity, and long and discount, short and premium. Those are my extra ones that I can just add to my confidence from my trade. SMT is a probably the strongest behind the first and second confluence, because it's just a really strong confluence that helps me understand where market's gonna go for the day. Um, and then low resistance liquidity it's kind of like a overall bias understanding confluence, right? Like low resistance liquidity helps me understand, where we want to go for the day and where we want to run through for the day, right? Because if we have a bunch of liquidity resting lower, right, it's obviously that we want to run through all that liquidity. So it's pretty obvious when you see it in the market. And then number five, people, I don't see this enough. I don't see this strategy enough. I don't see this confluence enough, which is, not good. But essentially, what logging a discount means, let's say, here, let me go trading view real quick. Let's say right here. I'm trading a continuation, right? We tapped into the hourly gap. I would not take this trade, by the way. We're in an hourly gap. 15 minute has a nice retrace, right? Let's just say we got OTE somewhere. Let's just say we had 0.79. All right. So all of my confluences align. Um, and I'll take out my GAN box, or you can use the fib. It doesn't matter. And I'll see, right, where is the equilibrium of this range that we're dealing with? Because, right, you want to mark out, if we're taking longs, you want to mark out the swing high to the swing low, um, and then reverse for shorts. And with with this, you want to be making sure you are executing in discount of the range for longs, right? If you guys don't understand what discount and premium means, you can go watch a video on that that's more in depth, but I can kind of give a little rundown. So it's basically um, where price is at a premium and where price is at a discount, right? So say you're buying a bag of chips for $5, right? And $5 was the green line, the equilibrium mark, right? Say price goes under that, right? It goes to let's say it goes to $4. Obviously, you want to buy it because it's at a discount, right? And let's say price gets to $6, so it's like up here, above the equilibrium. That means that it's at a premium price, and you don't want to pay for it. You want to short it. You would not be shorting a bag of chips, but you get the point, right? So when I'm longing, I want to be longing ideally from here to here, this range, the green line to the one, right? This is my discount, range, and then my trades look something like this. Yeah, and then for shorts, it's basically the same thing, but it's just the opposite, right? It's pretty easy. I'm just gonna draw it out for shorts because it's kind of harder. So let's say we have lower low, lower high, lower low, lower high, lower low, lower high. Right? So what are we gonna do? Mark out swing high to swing low. Um, and then for shorts, it's pretty easy. It's just the opposite. We want to execute anywhere above equilibrium in the premium range, right? So anywhere from here to up here, right? Anywhere from here, anywhere you can find an optimal trade setup. And then ideally you would have OTE, you would hit 0.705, we would hit a high time frame gap, and then reaction out of it. But I'll go over all that later. You'd enter somewhere up here, right? But the reason why we're not entering shorts and discount or longs and premium is because it's just not optimal, right? We want to be entering at spots where they're going to give us the high probability of winning a trade, right? So up here allows us to catch the move earlier, which allows us to get a higher probability of getting break even, right? Because if you're entering down here, your break even spot could be, let's say for example, the only break even spot could be right here, right? You enter there, price goes up, works out you out, then delivers, right? But instead, if you entered up here, and then your stops were up here, and then you went break even right here, you wouldn't have got wicked out, and you would have hit TP. All right, so that's an example. And it's optimally, it's just better for RR, and it's just better for trade entries, right? It's simple, right? There's not much to it. You just want to be entering in the optimal spot. That's the ultimate key takeaway. Okay, so other things I need that aren't confluences, right? So obviously we need clear draw and liquidity. This consists of external lows and highs, internal lows and highs, session lows and highs, 4-hour, 1-hour gaps, data wicks, high time frame devil's marks. So I assume you guys know what all this means and what all these are. Um, I want to have all those. I want to have those that are just look very clear to me, right? Um, like for an example, okay, I'll go to my examples now, right? This is a trade that I took to secure my payout, I think. Actually, no, it's not, but I won this trade. So going into the day, what do we have? A clear trend, right? A clear bullish trend. We have up here, higher high, lower high. Now we're making the higher high. Or yeah, higher high. And going into the market, we have a draw on liquidity higher. We have New York AM high stacked right here. And then I think we also, okay, never mind, it's not devil's mark. And then we also, okay, we also have the key level up here, 30,000. That's, okay, yeah, psychological levels. Those are like key numbers, like 30,100, 30,200, 30,500, right? But once you get to like 30,000, 31,000, 32,000, the higher you go in the intervals, that's the better places to target. So that's also that's also a draw on liquidity, but that isn't used as often as the other ones I talked about. So going into the day, below we had a bullish hourly gap. So what do we do at market open? We manipulate lower, retrace into this hourly gap, create a SMT. I marked that right here. And then during that manipulation lower, we create a 5-minute bearish gap. We invert the gap, and then I long, boom, right? It bangs, even though I got shut out. But I don't know if I was entering in. I don't know the range of this, so I don't know if I was entering in premium or discount, but that doesn't matter for this day. I'm talking about yeah. Okay, go back to this clear trend, right? The way I put it is if a 5-year-old can identify the trend, then it's good, right? A 5-year-old can only identify bullish and bearish, right? It can't identify bullish, bearish, bullish, bearish. It can only identify, or sorry, not it. He or she can only identify up and down, up, not and down, 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 right? He can't identify up and down, right? The trend has to be very clear. If the trend isn't clear, it makes your probabilities way lower for the day, right? It's just simple. You want to have a trading market to take continuations because that's the whole point of continuations is to trade the lower leg or higher leg of that trend. And then last one is entry triggers. Entry triggers are things that make me like want to take the trade. Things that stand out to me that tell me, okay, enter now, right? They're like triggers. Uh, these include of displacement candles, IFEGs, engulfing candles, CISD. So my first trade, boom, we have displacement candle. Sorry, yeah, okay. Engulfing candle, we kind of have one. So an engulfing candle is when the body of the, say for example, we're taking this long right here, right? It's the body close of the bullish candle on the um out of the retrace. So if we close above this last bearish body right here, see we closed above it right here. Let me draw this out. So we closed above it right here. That is an engulfing candle, and that is where we could enter, right? I mean, I probably would have entered this trade if we closed like up here and we inverse this 1 minute, but I did not enter there. I waited for the 5 minute to show signs that it was gonna get inversed, right? And that's another one that I talked about just now, IFEGs. Once I saw this 5 minute get ran through, I entered, right? I didn't enter off a random candle like this one or this one, right? I entered off something that was actually valid, like a either 5 minute IFEG or a engulfing candle, right? Those are signs that show me that price wants to continue the trend. Um, CISD, this is in my other trade, so we can go over this day again, like I was going through my pre-market analysis. So a little trickier day here. I mean, I remember this day clearly. We had a dump, like 1,000 point dump overnight, and that's just clear bearish signs, right? A 5 road can identify that we're going down. But pre-market, or sorry, overnight, this overnight, we start to get some chop, right? Because we have to accumulate before we can distribute again after dumping 1,000 points. Just how the market works, right? We can't dump 1,000 points and then expect to dump another 1,000 points in the next session, right? We have to accumulate some time before we can dump again or pump again. So, all right, sorry, my dog was barking, but okay, once we see this chop here, right, on the hourly time frame, we can either expect to continue this chop into AM session, or we can continue, or we can expect to distribute lower and continue the bearish trend, right? So marking out our pre-market analysis stuff here, we have an SMT with Asia high and London high, or sorry, an SMT with Asia and an hourly high. ES did not take this out, showing signs that we want to continue bearish on NQ, right? So another example of low resistance liquidity for you guys right here. We have a low, a low, a low, right? And if I marked it out on the 15 minute, it would be better, but the hourly shows it fine enough. We have 3 lows right here that just want to get ran through, right? Whenever we create a lot of accumulation, either in one direction or the other, we are creating low resistance liquidity to be ran through, right? So if we were bullish, it would be flipped, but we would create low resistance liquidity like this. But instead we're bearish, so we're creating low resistance liquidity in this direction, right? So that's another signal that we want to run through we want to run through those targets and be bearish for the day. And also another thing, we just swept out London high and made a big reaction from it. So another thing. Going into the trade, we mark out our fib from the swing high. So this high right here was our swing high, as you guys can see here, and then our swing low, which was the market open manipulation low. It's not on here, but it's right here. So we retrace back up into this 15-minute gap right here with this candle right here, this big ass candle. And then we also end up hitting 0.79, right? So, and then we create an SMT as well. So all of our stuff is aligning, right? So now we're just waiting for either, let me zoom out, either displacement candle, IFEG, engulfing candle, or CISD, right? So we get a CISD right here, or if you wanted to enter, or if you wanted more confirmation, you could have got the other CISD right here. It doesn't matter, you can do whatever you want, but the optimal entry is obviously right here. We also had an engulfing candle. Actually, no, we didn't have an engulfing candle. Sorry, just CISD this time. And displacement candles are very, I would consider them like very volatile candles that just show signs that you want to pump in either direction, right? So like if this candle was like super volatile, I don't know how it was, but if it was super volatile and just like moving down hella fast, that's considered a displacement candle. Or usually they also happen when on the first candle of the distribution, not like the third, like what happened here. So yeah. Um, so yeah, all of our things line up here. Overall trends are bearish. We have a clear draw on liquidity with a bunch of lower resistance liquidity lower to get taken out. We have a fib level that we can mark out. We get a reaction to the 0.79, a 15-minute gap perfectly, and then we get displacement candle. I'll call this. Yeah, this is a displacement candle. We get a displacement candle lower and an engulfing or in a CISD lower. Boom, enter right there, and it bangs. Yeah, that's some examples that you guys could screenshot, look over, go over again. But go over risk management, right? This strategy continuation is high win rate and lower R. So when you have high win rate and lower R, you want to go higher risk, right? Just how the same as if you have low win rate, you want to be going for high RR and low risk. This is kind of like common knowledge, but obviously I'm going to explain it. So high win rate, lower R, obviously you're going to be winning more, but you're going to be making less money on the wins, right? So since you're winning more and you're guaranteed to have a higher win rate, you want to be risking more because you can capitalize off those wins, off the high wins, right? Because you have lower R, right? So if you had lower win rate and you had a high risk to reward, you obviously want to be risking low because you are winning less. So say, I don't know, for example, you have a 50K funded account, 50K eval, right? And you have $2,000 of drawdown. If you have a low win rate, say you win 25% of the time. I'm making this up. So you win 1 out of every 4 trades. And you're risking $500 per trade. Let's say, okay, you're risking 500 for both of these scenarios. 500 both scenarios. So let's say you risk $500, right? And you win 1 of every 4 trades. That's what equal, if you divide 2,000 divided by 5, or sorry, yeah, 500, that equals 4, right? So you would hit your maximum loss limit before you get your win, right? Because that's how your strategy is. You're a low win rate type of person, but your risk to reward is high. Let's say you average a low risk to reward, right? And you end up changing your risk because you are smart. So let's say you go to 300. And since you win every 1 out of 4 trades, that's 1,200. So that would be, you would have $800 left to draw down. So $800 left to draw down. 800 left, right? And let's say your average risk to reward is like, I don't know, 3. 300 risk times 3. equals $900 profit. So now you're at 1700 and you have a drawdown of 300. So you're back. You're basically back almost to break even, right? So you capitalize on the big wins, but you get big wins less. Um, the reason why I don't like this kind of strategy type is because if you're losing a lot, it doesn't matter how much you're risking. It's very tolling on your mental, and it's very hard on your mental to just keep taking losses in a row like this. Um, so that's why I stick with the high win rate. But let me go with the high win rate strategy now. So let's say you risk 500. As I wrote down earlier, it gives you a 3 to 4 trade buffer, or sorry, just 4 trade buffer, um, because if you risk 500 each trade, you have 4 trades to get to $2,000 maximum loss limit. Um, so let's say, I don't know, you win 1 out of every 2 trades. So say you take 2 trades, or let's say 3 out of 4. That's better. 3 out of 4. All right. Let's say you lose the first one. It's minus 500. Now you are at 1500 left of drawdown. So 49, 500, right? But you end up winning the next 3 because you have a high win rate, right? And you go for lower R so you can get the high win rate, because these people that have the low win rate strategy are going for higher R, so it's much harder to win trades for them. But with the lower R, it's easier because you're going for less points, right? So let's say you win the next 3 in a row, and you got a 1-to-1 each time. Let's say you got a 1-to-1. You would be at 51,000 because that's 3 trades in a row, right? And then let's just say you kept repeating that process, 5,500, and then obviously you win the next 3, so you are at 52,000, right? And you keep repeating that one more time until you pass the account, right? So that's an example on how that risk management kind of works. What I like to do is I like to risk 1.5%, so that's 750. But that's only for evals. On XFAs and expresses, I risk 500 just because it's like real money. I don't want to blow that account that easily. But I'm obviously more risk on with my evals just because I want to get them passed quicker, right? Example I want to show you guys was, this is a screenshot from one of my TikToks. Was that here? This is on my XFA, right? This is on when I got my payout. Thursday and Friday, the 5th and the 6th, 2 break evens, right? -8, -$13. The next week, Monday, Tuesday, Wednesday, Thursday, I won every day, right? So 546, 412, 610, 462, right? My max win is like a 1. Let's divide that. 610 divided by 500, because I'm risking 500 every single trade. That's a 1.22 RR. My max win here was a 1 to 1.22 RR. Like, that's how low I'm going for, but my win rate is much higher, right? Like right now I have a 100% win rate because I haven't lost. I only got 2 break evens and then I got 5 wins. Um, but yeah, that just shows you guys how much more consistent you can be if you're going with higher risk but less win rate, right? Um, but yeah, that's an example I wanted to show you guys. I think I went over everything I needed to go over. Obviously, it takes time to learn every single strategy that you can find. You got to back test it, collect data on it, because back then I wasn't taking these type of trades. I was taking much basic trades and much more simpler trades, but I kept losing a lot. That's what made me having to refine my strategy and learn what was actually wrong with the strategy so I can improve and have a win rate like this. Um, and yeah, let me know if you guys have any questions down in the comments below. And yeah, I'll see you on the next video. Thank y'all for watching. Peace.